This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of July the 3rd, 2026. July already. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. Patrick, happy July. There we are. We're done with June. It came and gone like Noah's Ark, at least here in Edmonton.
Yeah, we're all lining up 2 by 2, and got to remember to take the snorkel out with your cup of coffee when you head out in the morning. We kind of move on. It's kind of this halfway point of the year. We kind of take a look at just a couple of expectations about the market. So it's gonna be a short week in the markets. We got to take that into consideration, and so expect trading volumes to be kind of quieter this week. If we kind of think back to the last podcast, as the S&P 500 is up slightly, the TSX is basically flat, oil prices coming down. I don't even want to talk about that situation anymore because it seems like it's constantly in flux, but lower oil prices are a good thing. Let's just, hope and pray that situation in the Middle East stabilizes. Western Canadian Select, we talked a lot about how this was kind of working in Alberta's favor, that differential between Western Canadian Select and WTI had been narrowing, while the spreads kind of widened on that again. So we've kind of moved closer to where we were earlier in the year with a differential of about $14 a barrel. So I think that's very much reflecting that demand is coming off right now. Gold continues to weaken. We're looking at just some technicals on gold, and we actually think that gold could really kind of pull back, and that's something that's important to my clients. We've had gold in the portfolio since 2020, done very, very well on gold, but the conditions that have led to higher gold prices have changed. We're going to talk a little bit that in today's podcast, and then Bitcoin. That'd be another one to kind of watch out for, is that the conditions for Bitcoin, over the last couple months have actually been pretty good. We have risk on trade, interest rates were relatively flat. We're going to now move into some conditions where, interest rates are rising and the environment for Bitcoin could actually weaken more. So for people that are Bitcoin bulls, they might want to hold on to the horns, because we could see further weakness in Bitcoin, which is down about another 2.35% at around 58,000 US. So quick kind of market update there.
If only there was a way that we could invest in mosquitoes, because they seem to be there's your bull market right there.
Yeah, and we had talked about Alberta leading the country in various factors in our episode 25 podcast. We that wasn't one of my calls for 2026, was a bull market in mosquitoes.
Yeah. With this being the beginning of July, how much of what you just talked about in kind of a market update for this week, how much of that is redundant, and what else is there for like a review of the first half of the year?
Yeah. So for the context of our listeners, I would say that if I thought of all of my clients, is I would say that the most common portfolio allocation for my clients is somewhere around that, about 30% in fixed income, about 70% in equities. And I would, I often call that our classic growth portfolio. And so if we're when we look at our June 30th statements and we do a tabulation of how we're doing with that particular allocation and where the markets are, is that the S&P 500 is sitting at about 9.25% year to date. The TSX is sitting at almost 9.5% year to date. Outside of North America, so the EFI, Europe, Australia, Far East Index is sitting at about 7.5% year to date, and bonds are sitting at about 1.7% year to date. So if we think of that weighting and we do a weighted average for that portfolio's return, is we're sitting at about a 7% rate of return before fees on a year-to-date basis. So as we're kind of doing a check-in, how are we doing versus the indices? And then we think back to our podcast 25, and we talked a little bit about what our outlook was for the entire year, is that we expected cash and treasury bills to deliver us about 2% for the year. So I would say that that's bang on. We've probably got about 50% of that year to date. We expected bonds to give us about 3.5% for the entire year. We are bang on in terms of where we expected bonds to be. With regards to U.S. fixed income, is that we expected low 4% rates of return. We're probably doing a little bit better on the U.S. fixed income side than that. Our forecast, so we're looking back to where we were, TSX at 32,000. We were forecasting 34,000 by the end of the year. We're sitting at 34,907. So we've actually already hit our full year target for the TSX. For the S&P 500, we were sitting at 6905. We expected a year-end finishing level of 7,400. We're sitting at 7,497 today. So doesn't take a math genius to figure it out that we are ahead of the game in terms of our expectation for our risk on assets, and we are pretty much bang on in terms of where we're at with regards to our risk off assets. And so some of the other things that we took a look at is that we, with regards to Canada and its economic growth, is we expected Central Canada to be weak. We were right about that. And we expected Alberta to lead the country in growth. And we were right on that. When we look at some other factors like the US dollar, we were wrong on that. We expected the US dollar to weaken slightly versus a basket of global currencies. And in fact, if we just look at the US dollar versus the Canadian dollar, is the US dollar has strengthened versus most global currencies, up about 3.6% versus the Canadian dollar. One of the reasons why gold is down so much. We expected 3 interest rate cuts out of the United States. Now we're not expecting any for the remainder of the year. That's a really big, important change. If we also just kind of thought about some investment themes, so this is from our podcast number 26, is that we expected the Canadian banks to have another good year. We thought that the setup was constructive for the Canadian banks to continue to do well. They have. The Canadian banks as a sector on average are up about 19% year to date. We thought Canadian industrials coming off of a really weak previous year. We thought industrials would really, suffer, or had suffered quite a bit because of the announcement of new tariffs on Canada. We expected improvement, and we did. If we look at the industrial index, which includes many of Canada's largest industrial companies and the rails, is they've seen a recovery, and that index is up a little over 20% year to date. So our wild card forecast for the year was something to happen in energy. Did something happen in energy? Well, we got that, but we didn't get it for the reasons why we thought we would get it. And so we were sitting at around $55 barrel, and the thing that I was looking at then was what the actual cost was globally to bring a barrel of oil to the market. And we saw this big differential is that if we looked global, we thought that the global cost was around $75 a barrel, but we were sitting at WTI of $55 a barrel. So, I expected that we would see global prices move more towards that cost. And boy, did we ever. I think what we realized, what's involved in terms of the true cost of having secure supply chain with regards to the world energy markets. That's really what the world became focused on over the month of March. And so, due to the Middle East crisis, we saw oil prices exceed well over $100 a barrel. They're trending down now, but likely when we look, when we finally get to the end of 2026 and we look at where oil prices averaged for the entire year, is we're probably going to sit around that $75 mark. Wouldn't be surprised. I look forward to that podcast and just seeing where they averaged out. And then the last thing that we kind of talked about was a theme was watch out for the Mag 7. Is that we expected a trip up. Now, we ended up getting that, but we got it for maybe a different reason. I felt that there would be a glitch when it came to the financial results due to all of the CapEx spending. And we may still see that. We're only halfway through the year. But instead, I think what we saw, we saw the semiconductor chips continue to do really well, but we saw the software related names really kind of pull back. So we've got a mixed bag in terms of the performance year to date with the Mag 7 stocks.
As we look ahead to the next few months up until the end of December, is there something like when we did the market update, you talked about gold pulling back, you talked about Bitcoin having a rough ride. Do we expect recovery in any of those things? I saw a headline this morning that maybe the U.S. and Iran were going to promise not to attack each other anymore. Is there going to be the geopolitical stuff that affects the markets more or investments more as we go from July through December?
Well, I'm never going to come up with a prediction with regards to geopolitical events, but I do think that this final sprint into the end of the year is going to get spicy. And the reason, for that is this isn't too much of a reach. First of all, so I've always talked about how important earnings are and how important forward-looking earnings are to the relative performance of stock markets. So in July, we're going to start to get some half-year earnings, and I expect earnings in general for Canadian stocks and U.S. stocks to be great. So just a really strong earnings season. Now, the guidance will be interesting, but I also expect the guidance going into the rest of the year to be very, very good. So there, big green check mark for that. Rates, though, we've kind of talked about interest rates, especially U.S. Fed fund rate, either being a tailwind to the markets or a headwind to the markets. This is going to become some real news. With U.S. interest rates, if we're not going to be getting any cuts this year, and in fact, we might get a rate increase this year, let's wait and see on that. But without rates going down, and then we look at the trend for longer term rates. So we see U.S. 10-year bonds going up. We want to keep an eye on short-term rates. So right now we have a steep yield curve. So, rates higher towards the long end of the curve, lower on the shorter end of the curve. That's a healthy yield curve. But with rates moving up, we want to watch to see if that yield curve starts to flatten, because that could potentially be a signal that shorter term rates could become a headwind to earnings, and that would be a negative for stocks. In general, that's a negative for stocks. So we have to watch that now that the inflation being higher, it's forced U.S. rates higher. So that's certainly an item to watch. The U.S. midterms. So a stat that came out today in our research package. So over the last 75 years, if we look at how the markets have performed prior to the midterms, is that the average rate of return for the 2 months prior to the U.S. midterms is a negative 11% rate of return. So we're expecting markets to get choppy before the midterms. And so, that isn't a condemnation on the health of the stock market. It's just we tend to see some investors move off to the sidelines a little bit, kind of this wait and see, and doesn't necessarily become a theme that always ends up remaining intact for the remainder of the year. But with the midterms coming near the end of the year, is that we would expect some year-end chop due to that, but happening at a time where earnings are great. So certainly something that we want to watch. And then I think lastly, something that would be very confidence building for the markets is if we just saw some broadening out of the market. So we want to see other businesses besides U.S. tech, outperforming. So besides U.S. tech creating leadership. Now that's really, really hard when you just see strong earnings coming off of sectors like the chip makers. But if we were to see U.S. financials, U.S. healthcare, U.S. industrials come out with some really strong earnings, this broadening out in the market, is that would give us a lot of confidence to say we could go into the end of the year and actually see results, better than we expected, when we did our initial forecast for the 2026 return. So those are going to be some things that we're going to be watching: interest rates, inflation, results to the midterms, but this broadening out of the market. I'm looking forward to the podcast where we can talk about that and be excited about some things other than, GPU and TPU chips, that we can actually talk about, some great things happening in some other business sectors.
Well, it's a good thing we've got our Donald Duck water wings, because the choppy waters ahead could throw us out of the dinghy from time to time.
Always swim with a buddy.
We'll see. That's why we've got you here. Thank you very much. There you go. That's the Wealth Roundup for July 3rd, the week of July 3rd, with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. If you would like to find out more about wealth management or start your investment journey, find Patrick's contact information at www.patrickmleonard.com.
Thanks, Terry. Have a good week.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.